What's up, you guys? This is Gustavo De Santis, and I'm here with you today to discuss our next topic. So, first of all, what I want to say is that I know that in my last video I was wearing my workout t-shirt, and today I look a bit nicer, but this week it was my birthday, so I was like, let's look a little fancier, you know, a little bit of this, a little bit of that. Now, the reason why we're doing this video today, we're doing this video because we don't like those people that when they're speaking with you, they're bossing up about financial markets. They're bossing up about hedge funds. We don't like the people that are like, oh, I work in the stock markets, I work in the bond markets. And let's be very clear here, there are many people that are very smart, that work in this industry. And we like them and we respect them because those people, they're very cool people. We just don't like those people that want to show off their smarty brain. So, let's keep on going. First of all, I want to say I'm not a financial advisor and you should never base your financial decisions on what I say in my videos. But at the same time, I hope that you're going to enjoy my videos and that they're going to be entertaining for you. So, please guys, if you like those videos, smash the like button and let's keep on going. First of all, I want to start the video with a sentence that comes from a rap song that I was listening to this week. And the song is from Kenneth Parrott, and it goes like, I'm book smart, but where I'm from, you gotta think straight. And I don't think I'm book smart, I don't think where I'm from, you gotta think straight. But this is gonna be the vibe within which that we're gonna use to coast on the video, you know? So keep that in mind. First of all, I also want to start mentioning 50 Cent, and you know who he is, the G-Unit guy, the rap guy. And when 50 Cent is speaking about financial markets, he says that financial markets are very tricky because it's very easy to go down, and when you go down, there are many people that they're stuck there. And it's understandable because financial markets are not an easy game to play, and if somebody's gonna tell you that he knows how to make a lot of money and he knows if the market is gonna go up or if the market is gonna go down, you should think twice about that. Ray Dalio, referring to this, Ray Dalio, he's a very smart guy in financial markets, says that it's easier to win at the Olympic Games than to win in the markets. So we should trust the boss in the game, you know? I have no idea where financial markets are gonna go. I don't know if the stock market is gonna go up or if it's gonna go down. I have no idea. I don't know how to outsmart the financial markets. I don't know how to outsmart the bond market or the stock market. So keep in mind that it's very hard to find a good person that knows that. Probably the majority of the people, if not everybody that you know, doesn't know how to win in those games. But let's keep on going. Today we're talking about hedge fund. And the title says, a hedge fund explained by the street dealer. And what kind of street dealers were you guys thinking about? Because when I think about a street dealer, I think about Timmy, the guy down the road, down the street in New York, Brooklyn, that has a small grocery shop, and Timmy's selling every type of grocery in his shop. And that's gonna be our dealer, and we're gonna use Timmy's example to explain and contextualize situations when we can, of course. It's gonna be a little tricky, but we're gonna do our best to do that. And we have to say that in some cases it might look we're oversimplifying, and also in some cases it might look like we're wrong. But please guys, stick with the concept of the video and the goal of the video, which is gonna be to let an everyday person understand just a bit more about financial markets, hedge funds, and the concepts that are behind this word. And I hope this is going to be a bit helpful as well. So let's start with the hedge fund. What's a hedge fund? First of all, let's start to say that the word, the hedge funds comes from the concept of hedging. And we're gonna go more deep into this concept later on. But does every hedge fund really hedge? The answer is no, not every hedge fund hedges. And we can define a hedge fund as a pool of money that is coming from a very high net worth individual. Let's say 1 million net worth individual, and sometimes it can be more, sometimes it can be less, but you get the concept. It's a high net worth individual and institutional investors. So the pool of money is coming from those two types of investors in the majority of the cases, and this money is given to a guy which is our hedge fund manager. And the hedge fund manager's job is going to be to make more money with the pool that he gathers on the markets. Now, we have to say two important things. That there are different type of assets in which the hedge fund manager is going to invest. And there are the conventional assets and the alternative investments. Let's analyze them one by one in order to try to understand a bit more. And in order to be very clear and precise, we're going to read the definition from Investopedia of every one of those terms. And then we're going to make an example with Timmy, our street guy, our street dealer. And we're going to try to contextualize and give an example of every asset class. So the conventional assets in general are stocks, bonds, cash, and real estate. While the alternative investments can be, for example, derivatives, convertible bonds, or they can be options, or they can be currencies, or they can be commodities. Let's start with the first type. So we're going to go with stocks, and the definition by Investopedia says, a stock is a security that represents the ownership of a fraction of a corporation. Okay, now let's think about Timmy's business. He owns a grocery store. If we take the equity value, so we give an equity value to the grocery shop, and we divide that equity value into fractions, we can define that as a stock, okay? Now, let's go with bonds. According to Investopedia, a bond is a bond represents a loan made by an investor to a borrower. Now, in order to put it into different words, let's word it differently. We can say that if Timmy's business, which is the grocery shop again, wants to take his debt, divide it into fractions, and sell it to an investor, that can be considered a bond. And I know we're oversimplifying here, I know we're not mentioning interest rates, and we can go so much deeper into this topic, but again, this oversimplifying. Then we have cash. Cash is kind of self-explanatory, and according to Investopedia, cash is the legal tender, currency or coins that can be used to exchange goods, debt, or services. If we consider Timmy's business, we can say that cash is the amount of actual money that Timmy is going to have in his business at the end of the day after he has sold products, and this is going to be the money that he has in his cash register, okay, or of course in his bank account from the money that he has in the bank account that came from payments that were not made in cash. For example, credit card, debit cards, and all those kinds of payments. Then we have real estate, and we can say that real estate can be we have two different types of real estate. First one is commercial real estate, and commercial real estate in the case of Timmy is going to be the physical shop in which Timmy is operating his business. And we have residential real estate. Residential real estate in Timmy's case is going to be the house or the building, where Timmy is conducting his personal life with his family. Now, let's dive into alternative investments. First one that we have is commodities. Commodities, according to Investopedia, it is a basic good that is used in commerce that is interchangeable with other goods of the same type. If we refer to Timmy's case, we can take a commodity example, we can take, let's say, grain. That's gonna give us an idea. Now let's go with options. An option is a contract that offers the buyer the opportunity to buy or sell depending on the type of contract they hold. Now in Timmy's case, we can make this example. Let's say Timmy is gonna buy eggs from his supplier, and Timmy is also gonna buy an option contract from his supplier, and the contract is gonna say, look, if I'm not gonna sell all of the eggs, then I'm gonna give the eggs back to you. And Tim is gonna pay a premium in order to have this contract and to have the ability to do that. Interesting. Now we have currencies. According to Investopedia, currencies is a generally accepted. Let's rewind. Currency is a generally accepted form of payment, usually issued by a government and circulated within its jurisdiction. If we think about Timmy's case, as we said before, Timmy is operating in Brooklyn, New York, so he's operating in dollars. Now let's imagine his cousin, which has the exact same type of shop, but in Paris, France. Now the cousin is operating in euros and Timmy is operating in dollars. We can say that every day there is going to be a fixed price for which we can exchange one unit of dollar for a given amount of euros. And this price and this combination is going to probably change every day. Let's keep on going. Convertible bonds. A convertible bond is a fixed income corporate debt security that idles interest payments but can be converted into predetermined number of common stocks or equity shares. Now, what does this mean? It means that Timmy's business can have the ability to issue a bond that in some circumstances can turn into stocks, common stocks. And this is pretty much a convertible bond. Now let's go with derivatives. A derivative is a financial asset that take its value from an underlying asset. Now, again, oversimplification in this case as well. It is it's a bit more technical, but we're gonna make it easy, and we're gonna say that in order to do a derivative, Timmy is gonna take a cake, and Timmy is gonna slice a piece of cake, and that piece is gonna be separated from the whole cake, and we're gonna give that value, and we're gonna give a value to that piece of cake, and the value comes from an underlying asset. This kind of is the concept behind a derivative, and this was the last one. Now again, guys, we're oversimplifying. We're trying to give the most clear explanation, but I know, please, that probably some of you have another way or a more clear way or a different point of view, and please let me know in the comments. That is amazing, because I know that many of you guys are very smart. So this channel is all about the no PhD broskis. We're all the no PhD broskis. So if you want to improve the quality of this channel and let me know more and let the other people know more, that is just gonna be amazing. Now let's keep on going. Let's discuss what is the legal form that in general hedge funds are using to operate, because we know that every time a group of people is put together in order to sell a service or a product, we need a legal form to represent that. Now in the United States, in the majority of the cases, that is going to be an LLC. If you want to know what an LLC is, easy, go on Google it, there's gonna be the answer. Cool stuff. And now, let's get into some juice here, because we're gonna describe some common practices that hedge funds use when they are operating. And again, we're sticking with the basics. Let's go with a long position. What is a long position? In this case, we're just gonna consider a small portion of what we have discussed before, and we're just going to consider the stock market. So a long position on the stock market, on a stock, it means that somebody's gonna buy a stock, and this somebody is gonna think that the price of the stock is gonna go up in value in order to sell the stock later on for a higher price. To simplify this, referring to Timmy's case, we can say that somebody's gonna invest in Timmy's business, and that somebody's gonna suppose that Timmy's business is gonna perform well. So Timmy's business is gonna have a higher value in the future, thus his investment is gonna be a profitable investment. Now, let's consider instead short selling. Short selling, it means, oversimplified again, because there is a concept that is a bit more technical behind. If you want, you can Google that. And short selling means pretty much betting that a given stock is that the price of a given stock is gonna go down. So, referring to Timmy's case with his grocery shop, we can say that an investor is betting on Timmy's business on having a bad performance in the given period considered. And that's the concept behind short selling. Now, at the beginning of the discussion of hedge funds, we mentioned hedging. What does hedging mean? Hedging means to mitigate the risk associated to a transaction through doing another transaction. Super simple example again, maybe not the best one, but we're gonna say that every time that somebody has a long position on a stock, there is the risk that the stock is gonna go down. So if somebody wants to hedge that, probably they're gonna take also a short position on that stock. You know, the risk goes up, the risk goes down, it depends how you do things, because every asset is always going to have a risk related to it, but you know, the key concept is every time how you do things. Let's proceed with leverage. Leverage consists in borrowing more money in order to have the ability to invest more and thus generate a higher profit through investing. If we think again about Timmy's case, we can consider leverage as Timmy borrowing more money from the bank, so he's gonna have more liquidity to buy from the supplier. Thus, Timmy will be able to sell more products. But again, there is a risk related to this, because if Timmy is gonna borrow a lot of money and he's gonna buy many products and he's not gonna sell those products, he's gonna have a big loss. So you see, there's never a real good answer in every situation. Everything depends on how you do things. Okay, guys, and those were the main concepts that we were discussing today about hedge funds, and now there is the fun part. This is a bit the freestyle that I'm gonna give as a present for you, because I didn't prepare this part. I don't know, I'm gonna structure this, and I'm just gonna say what I think about online brokers, okay? I'm gonna contextualize with what happened the past week on the market, more precisely on the stock market. And in the GME case, so the Jewish guys. What can we say about that? First of all, we can say that that was the case of a hedge fund that we just discussed now. And of course, guys, there is so much more to say about hedge funds. We're just discussing a small, tiny little part. But let's keep going with the story and the concept. What happened is that a hedge fund shorted one stock, GameStop stock, and what happened in this case that a group of investors, retail investors, gathered together on a social media called Reddit, and they were against this hedge fund that decided to short the stock, and they started to buy many stocks of this company in order to make the price skyrocket. Now we have to say that when somebody is shorting a given stock, in the worst case scenario, he's gonna lose a lot of money if the price of the stock is gonna skyrocket for some reason. And this was the case for the hedge fund that shorted GameStop stocks. And this is pretty much where the madness was born, the madness of buying more and more stocks. What happened now? What happened this week is that the online brokers decided to stop the option to buy more stocks for the retail investors. And this was something, guys. This was really something, because this is a very, very, very rare case. And of course, the retail investors did not like this. They didn't like this at all. This leads to many questions, honestly, and to which I don't know the answer. This is pure food for thoughts. Like, for example, are the retail investors gonna trust online brokers in the futures? I don't know. But if they don't do that, what are they gonna do? How are they gonna invest their money? I don't know the answer to this as well, honestly. But cool stuff to think about, honestly, because it's mad. Another thing that comes to my mind is, in this case specifically, the retail investor was a first-time trader for many people that were trading the GameStop stocks. And I'm asking myself, is the average person gonna become more sophisticated about investing in the future? I don't know. Maybe. Because through online brokers now there is the opportunity to do something that is more than being long on a stock, than having a long position on a stock. But I'm asking myself, in the future, retail investors are gonna short stocks. Are they gonna do it all together, organizing on the Reddit forum? If they do, that's unprecedented. What are the regulations gonna be on that? How do you manage what's happening on social media and what's happening on the markets? Even because it's something that is, we can say that it's kind of new, right? The combination of finance for retail investors and social media, also, we have to say, together with madness, guys, it's something never seen before. We've never seen this before. And also, let's say, this was not investing. This was more of a bet. It was a bet. It was some nonsense purchase of stocks. But I think it was so cool. I think it was so cool for sure. Let's also mention that every time that we're playing this game, it's a zero-sum game, in the sense that somebody's gonna win, somebody's gonna make money, somebody's gonna lose money, okay? So it's not like, don't think that everybody's gonna make money. It's not like that at all. Maybe we can say that in the majority of the cases, it's the worst, it's worst case situation for the average investor. But man, I think it was so cool. The past weeks in the financial markets, they were something unprecedented and never seen before. That's a revolution. That's a revolution in the way finance works. And we can say it was just a revolution for a small portion of the market. We can say retail investors were just moving one stock, and there are so many stocks, and there are also very different markets, because this was happening in the American market. But man, this was unprecedented. And that's mind-blowing to me. Mind-blowing. I don't know what's gonna happen next. Please guys, if you have some insights, let me know in the comments. Let me know. Write down what's gonna happen according to you. Write down if you think it's the whole market is gonna change, or if it's gonna stay the same. If you think that, why not? And also another thing that I was thinking about is new types of investments are coming on. Like, for example, people now can invest in cryptocurrencies. Are people gonna do combined mass purchase of cryptocurrencies? Because we kind of had that the past week as well. It was, if I'm not wrong, with Ripple, the value went down more than 60% in a few days, and that's pretty crazy. We also had a pretty big rally with Bitcoin. I don't know what's gonna happen. I don't know what's gonna happen between the combination also of regulation, social media, cryptocurrencies, madness, people going mad on this. It's kind of intriguing. And so I have to tell you something, guys. Between the people that are watching this video or following me, there are some very smart guys with cryptocurrencies, and we're gonna learn from them. We're gonna learn from that. For sure, I will learn from them. We're the no PhD broski guys, and every broski of the no PhD guys is gonna bring some value. And that's it, guys. That's about it. During this video I was looking a bit nicer, dressing up because it was my birthday this week again, feeling fancier, some jewels. And I will see you guys in the next video. From your boy, peace.